Hey everyone, I'm Eric Thompson. I'm president of Windermere Real Estate here in Colorado. I'm making this video for you as a recap to our market forecast that we had in Denver. If you made it to the event, thank you so much for being there. If you didn't make it, we hope to see you there next year. In any case, I'm going to make this recap for you to show you the highlights. I want to start by thanking our sponsors of the event. Elevations Credit Union was our presenting sponsor. I also want to give a big thanks to Old Town Media, to Fidelity National Home Warranty, and also to BPG Home Inspections for your support of our event. A little bit real quick about our company. In case you don't know, a little bit about Windermere Real Estate. This is where we're located all over the western U.S. We have 6,500 agents in those markets that you see there on the screen, over 300 offices. We're growing up and down the Front Range and are really excited about our growth here in Colorado. Our company is famous for a couple things. The first thing our company is famous for is the Windermere Certified Listing. That's where we pre-inspect our listings so that we can help our sellers to uncover items that the buyer may find out anyway, and also as a way to be really transparent to the buyer, and it really helps the process along. We also are famous for our market information. So we're famous for the Gardner Report is our economic report that comes out every quarter. We're happy to get that in your hands. That can really help you out to understand what's going on in the market. And then every month we produce the Windermere Report printed newsletter. We are happy to mail that to you if that would help you out as a way to just stay updated on what's going on in the market. All right, so here's the question that we get a lot, and the question that we answer with our market forecast. The question is, how's the market? And what we like to say, it's kind of like a flight of stairs, all right? So as we talk about prices, what we know is that there is an average pace that our market climbs the stairs when it comes to prices, and that average pace is 5.5% per year. Well, what happened after the Great Recession is that pace slowed down, right? So it slowed down all over the country. Didn't slow down quite as much here, but it did slow down. So then between 2013 and 2018, we had to run to catch up. So we had to run to catch up to our pace. And what happens when you run upstairs, you get tired, right? So what we noticed in 2019 is that the pace of price acceleration slowed down. Prices are still going up, just not as fast because we got a little tired from running up the stairs for those 6 years, 2013 to 2018. All right, so here's what we notice about prices. We know that the long-term average appreciation is about 5.5%. From 2013 to 2018, you can see what prices did here. They varied per year between 7.8% and 11.8%. So we are well above the average appreciation per year. So then what we noticed just this last year is prices were up about 3.5% around the Denver metro area. So again, prices still going up, just not as fast. So that's the first thing we noticed about the market. There's also good news. There's less crazy and less drama in the market. Buyers realize today that they have much more leverage than they have because price acceleration is slowing down. More inventories come on the market. Buyers now have more leverage than they have before. And sellers now are held to a higher standard than they have been over the last few years. There are some things that sellers could get away with, maybe overpricing or maybe the condition not being perfect. Today, buyers are much more selective and discerning. Our sellers now are held to a higher standard. This is kind of a funny slide I showed 2 years ago at our market forecast event. This was an example of all the offers that we were considering. So we had a listing that had these 14 offers on it after just 24 hours of being on the market. That happened 2 years ago. That's not happening now, all right? So sellers today are held to much higher standards. So right now the market really is becoming more normal, but the strange thing is that feels abnormal because it's been a long time since we've had a normal market. We had Matthew Gardner, of course, at our economic forecast. He's our keynote speaker. He's our chief economist for Windermere. We're lucky to have him. He flew in and gave us his presentation on the market. I'm going to show you just a few of his slides. We're happy to get you the whole slideshow if you'd like, but I'm going to show you some highlights from his presentation. So a big question that we get a lot is there going to be another recession? And when is the next recession coming? Those are big questions that we got. Matthew Gardner addressed that. So one point he made is that, you know, recessions happen. It's a normal thing that will happen in any economy like ours. And this is the average length of time, or this is the number of months in between recessions. And you can see in our current market expansion, we've gone 127 months without a recession. So we're kind of due, all right? So when the next one happens, it's just just going to be a normal thing. And again, it's just part of the cycle of any economy. He looks for a few different signals to tell us if there may be a recession. So these are the four main economic signals that he would look for to predict a recession. This is his version of the canary in the coal mine. So these are the four things that he looks for. So the yield curve, this is kind of advanced economics that some of you may know about. The yield curve did invert back a few months ago, but then it reverted. It's not inverted anymore, but an inverted yield curve does sometimes predict a recession. So that did happen, but then it reverted. But these next three items do not show evidence of a coming recession, all right? So the unemployment rate right now is very low. The manufacturing index does not show signs of a recession. Consumer sentiment is high. So these four things together would tell him that a recession is coming. These are not on his radar, so he does not expect a recession in the year 2020 because of these things, all right? So here's what he does see for the national economy is continued growth in gross domestic product, around 2% for the subsequent quarter, so still pretty healthy economic growth nationwide. Then we got into the U.S. housing market. So before we talk about Metro Denver, we'll talk about the U.S. housing market. So one thing that's interesting related to a recession that we were just talking about, he went and looked at what happens to home prices when there is a recession. Well, for the most part, the last times there have been a recession, the average price of a home stays pretty much the same or even goes up slightly between the beginning of the recession and the end, other than one time, and that was the most recent recession that we all remember. The reason why prices went down, Matthew Gardner says, is because this was a housing-driven recession in the first place. So for the most part, recessions don't cause prices to go down, just something to keep in mind. So now let's talk about the home market and existing homes and what he sees nationally. So what he does expect to see is that the number of transactions nationally will increase 2.7%, but still nowhere near the above 7 million homes that were selling nationwide back in 2005. Still quite below that, but the good news is that we're going to see an increase in the number of transactions nationwide. We're also going to see an increase in average price. So this is nationally, he sees prices going up 3.7% nationally from 2019 into 2020. So that's good news. That's just a sign that nationally the housing market is still strong. One interesting dynamic as we look at housing nationwide is that we're staying in our homes longer. So the length of time that we're staying in a home on average is pretty much doubled between the early 2000s when it was just over 4 years and today we're at 8.2 years. So the length of time that we're staying in our homes has doubled. People are just more apt to stay in their homes longer. We don't see this big turnover of real estate like we have been seeing. People are staying in their homes longer. This is an interesting way, one of, by the way, many ways that we look at, is there a housing bubble right now? And there's so many different indicators that we're not. This is just one. You may have heard of this index called the Case-Shiller Index. That's a pretty well-known index that tracks prices in the 20 major markets nationwide. And the blue line shows what happened to home prices and what has happened. And you can see the bubble forming right here in the late 2000s, the bubble bursting, and then prices going back up. So it looks like that we've gone way past the prices and where they were before the bubble burst the last time. But what Matthew Gardner did is he evaluated those numbers and he created this red line where he adjusts for inflation. And when you adjust for inflation, we're still well below the peak of where they were. So we're still 5.8% below of where prices were the last time that we did have a bubble. So again, just one of the many ways that signify that we don't believe we're in a housing bubble today. Affordability is a really common topic and was something we get asked about a lot. So the National Association of Home Builders, they put together research that tracks affordability. This is a list of the most affordable markets in the country, and how that's ranked is the percentage of homes that you could buy with the median income in that market. So you see lots of places in the Midwest, some on the East Coast, and you can see that nationally the average is 64%. So nationally, you could buy 64% of all the houses for sale with the median income. Again, these are the most affordable markets. These are now the least affordable markets. So what's in common among these is that they're all in California for the most part, or I guess all of them are in California. And then you can see how Denver is ranked right here. So Denver is kind of halfway. So in Denver, you could buy 55% of the homes with the median income price. So we kind of sit there in the middle of the most affordable and the least affordable markets. Matthew Gardner talked about his prediction for mortgage rates. Obviously a big topic as it relates to real estate. People wonder about rates. The short version of this is that Matthew Gardner does not see interest rates going above 4% for at least a year. That's great news for home buyers both today and going throughout the year. He does not see rates going above 4% until at least the first quarter of 2021. So he sees rates staying around 3.8, 3.9%, which is incredible. These are incredibly low rates. Essentially, they are half of the long-term average. People today are getting money on sale, basically half off. Another topic that's interesting to look at related to real estate, of course, is how many people are owning versus how many are renting. What we saw several years in a row, so this is going back to 2009, many years in a row, many quarters in a row, where there were more renters than buyers in terms of year over year. So renters were growing faster than owners for many years in a row, but then that flipped in 2017, where now owners are growing. So there's a lot of talk right here about we're becoming a renter nation and people will never want to own a home again. Well, that's just not true. What that changed right here, and really what happened was we now have millennials reaching the home ownership portion of their life. You know, they've reached the part of their life where now they want to own homes, and that's what's happened here starting in early 2017. We did talk a little bit about millennials at our market forecast. Some interesting things is to look at where they are buying and to look at the specific percentage of millennials and how they make up the overall home buyers and homeowners. All right, so you can see all the markets, a lot of the major cities where Windermere has a presence, and you can see the particular percentage of millennials in that market and the share of home buyers that they make up. In Denver, it's 50%. 50% of all home buyers are millennials, so they're a big market right now. They're the largest demographic, and clearly they're making up a big percentage of all home buyers. We get asked about a housing bubble all the time, right? So I mentioned that before. There are some distinct reasons why Matthew Gardner, our economist, does not believe we're in a housing bubble today. Let's look at those reasons. The first reason we look at is credit. You may remember that a big reason why we had the bubble the last time is that there were a lot of people with poor credit who are buying homes. We were just extending home mortgages to people who really shouldn't have had home mortgages. Well, today, the credit scores for the average buyer are very, very high. So right now, average credit for a home buyer is 755 points when you look at their FICO score. That is incredibly high. So we see overall, buyers have great credit, so we're not concerned about a bubble for that reason. Another reason why we're not concerned is that there's a tremendous amount of equity in people's homes right now. So we don't see homeowners in general nationwide who are overly leveraged. We see that there's close to $19 trillion of equity in homes right now. So this is the value of homes, this is the debt, so this is the equity, just under $19 trillion of equity in people's homes right now. And you can see that the amount of debt has stayed pretty flat for the last several quarters in a row, so we don't see lots and lots of debt being put on homes. That's another reason we're not concerned about a bubble. Another big reason is that the percentage of people getting an ARM right now is incredibly low. So adjustable rate mortgages are very, very low. We're back pre-bubble in 2004. Over a third of all loans were ARMs. Today, they're only 5%. All right, so this was a big reason why the bubble burst, is that people had those ARMs and those ARM rates started to go up and they couldn't afford the payment anymore. They had to give the house back. Well, that's not happening now because only 5% of people even have ARMs. A little bit about the Denver economy. One is to look at employment growth that's been occurring in the Denver metropolitan area. 2.4% is incredibly strong. Really, any number over 2% is a strong number, any economist would tell you. And now we're looking at employment growth in the forecast for Metro Denver. Matthew Gardner predicts in 2020 will add close to 34,000 jobs in the Denver metro area. That's great news for real estate because the economy is growing. Unemployment rates continue to be incredibly low. You know, nationwide, they're very, very low, 3.5%. Colorado, they're low. Metro Denver, they're low. Both of those around 2.5%. We have very, very low employment here locally because of our very strong economy. Our population is growing. I don't have to tell you that. All you have to do is drive down I-25 and see the number of people who are living here now. Our population is growing. It's expected to grow in the Denver metro area another 37,000 people, and you can see that in Colorado it's grown close to 80,000 people. So a little bit about the Denver area housing and the Denver area housing statistics. So we're going to look at just Denver County, by the way. We have access to, and we have slides for the 5 major counties of Denver, but just in the interest of time in this video, I'm just going to show you Denver County. You're going to get kind of the theme, and you're going to see the trends that you notice here for Denver County are going to be the same for the other 4 counties, and again, we're happy to get you the slides for those 4 counties. So no surprise, prices have been going up by a considerable amount over the last several years, and also the number of transactions has gotten to be pretty steady over time, but we mentioned before that prices have been going up about 3.5%. And here's what Matthew Gardner predicts for the year 2020 in Denver County. What he predicts is that prices will go up 5.1% in the year 2020. Again, if you want to see the specific forecast for the other 4 counties, we're happy to send that to you, right? So we see that prices are going to be very close to the long-term average. So the long-term average appreciation is 5.5%. What Matthew Gardner predicts is 5.1%. So still growth in home prices, just not as fast as we have seen before. We're seeing home price growth similar to what we've seen over the long-term average over 40 years worth of data. So we'll finish with this. Where's the opportunity in the market? So we see a few clear areas of opportunity. Number one, we see opportunities for the move-up buyer. There's opportunities for the move-up buyer because of the equity that they have in their homes, because of interest rates being so low, because of inventory now starting to come up. There's more to choose from. And for the person who's always dreamed about that particular neighborhood or always dreamed about that certain kind of home, right now is an amazing time, especially with less crazy and less drama in the market. Right now is a great time to enter into the market, leverage the equity that's in your home to be able to own that home that you've always dreamed about. There's also opportunity for investors. Investors right now have a great chance of earning great appreciation and great income on their property because of interest rates. With interest rates being so low, you can lock in a low rate on your investor loan and then put a renter in that home, have the renter pay down the mortgage for you. There's great opportunities for investors. We have a checklist for you if you want to get your hands on that checklist to help you with investing. Then the last opportunity we see is with the sellers who can get it right on day one. So sellers who can shine on day one, really realize that the buyer today is more discerning, they're more selective, competition is increasing. We can't get away with incorrect pricing or incorrect condition. There is amazing opportunity for sellers right now to get it right on day one. Here's what to do next. The next thing you can do is to reach out to us to get some information. You can reach out to us at colorado@windermere.com, and we'll put you on our VIP list. And on that VIP list, we can get you our Windermere Report printed newsletter in your hands every month. We'd also be happy to send you our investor checklist, and you may also be curious to know what your home is worth today. We could put that snapshot together for you, get that in your hands, and we think that will really help you out. Even if you're not thinking about selling, you may want to know what is your home worth today. We're happy to help you with that. I want to thank you for engaging with this video. My name's Eric Thompson, and again, if you want additional information, including all these slides, including the entire slideshow from the presentation, reach out to your Windermere Realtor or contact us at colorado@windermere.com. We appreciate you engaging with this video, and I hope to see you soon. Thanks.